Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a consolidation where we have a parent-subsidiary relationship. That means that the parent is owning more than 51%, having a controlling interest, but not 100%. Therefore, we will have a non-controlling interest we will be dealing with. One of the major components we want to be looking in on is the fact that P, the parent, purchases S bonds from a third party. In other words, they weren't issued from S to P, but rather they were issued somewhere else by S, and then P purchased the bonds that were S bonds from a third party. This is going to be taking place in the year that we are going to be consolidating. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. We're going to be doing the 838 consolidation within OneNote. If you have a copy of it, we're going to go through the problem first, or the information for the problem. Then we'll be pulling components of that information as we go through the calculations related to it. We're going to have the P purchased a percent of S voting common stock on January 1st, 2000 X5. P is going to be the parent. S, the subsidiary. Purchase took place January 1st, 2000 X5. The percentage was 90% of purchase. So now P owns 90% of the outstanding stock of S. They're going to have the controlling interest. Therefore, the amount was $1,108,800. The cost of that 90% interest in S. The non-controlling interest fair value at that point in time, the fair value of the non-controlling interest at the point of purchase, $123,200. S net assets at purchase, meaning the net assets minus liabilities, or the equity section, equal to, of course, the equity section at the point of purchase of S, is $1,152,000. Book value and fair value of S are the same except for, in other words, if we took a look at the accounts for S, the subsidiary, at the point in time that the purchase took place, the book value and the fair value are going to be the same except for land, which had a higher fair value of the $30,000, causing a differential that we'll have to be dealing with. Luckily, however, there's no depreciation related to the land, so we won't have to be dealing with that. Then we have the April 1st, 2000 X6. P issued bonds to S at par value. So this is more of our simple kind of transaction with the bonds. Then we'll have a more of a complex type of one that we'll be able to compare and contrast to within the same problem, because this one, the parent issued the bonds directly to S. Therefore, when we do the transactions, they will mirror themselves. The journal entries on P and S will look much the same, and opposite, mirroring each other very nicely. Plus, they are issued at par, therefore no premium, no discount. The amount $200,000, rate 10%. We're going to have interest paid March 31st and September 30th, and therefore we are going to have then an accrual that we're going to have to deal with, because this ending date isn't at the end of the year. So we will have that we'll have to deal with. Then P purchased all of S outstanding bonds from unrelated company on January 2000 X7. So now we have the situation where P's purchasing S's bonds. S issued the bonds, but not to P. They issued all these bonds to someone other than P. And now P is purchasing the bonds from the third party that are S's bonds. So that's going to be a little bit more confusing of a transaction. And this took place in the current period that we will be consolidating, that being 2000 X7. So we're going to have to deal with that difference, that gain that could result from that transaction in the current year. Okay, so that's going to be for the 1 million. The years are 10. The rate's going to be 12%. They were purchased at 98, so 0.98 at a discount. That's what P purchased them for. P purchased them for a discount, but when they were originally issued, which happened in 2000 X1, they were issued at a premium. In other words, 101 of the face amount. So they were originally issued at 101 at a premium, and then when P purchased them from the third party, they purchased them at a discount at 98. So then the interest on December 31st and June 31st. So now we have December 31st and June 31st. So we don't have that accrual issue as much here, because they will be a payment as of the end of the year. Next, we have the inventory sale from S to P. This is going to be the subsidiary to the parent. This is going to be an upstream sale that we'll have then. Now, we're going to have then in 2000 X6, which is the prior year, we have the sales of the 66,000, and then the amount that's not resold, which is in the ending inventory as of the prior year, or the beginning inventory in the current year, and the amount that we would expect then to be sold in the current year is going to be that 17,000. Then we have the 2000 X7 current year items. the sales were 81,000 in the current year, this intercompany transaction sales related to inventory. The amount not resold, the amount then in ending inventory then at the end of the current year is going to be this 10,000. The gross profit is going to be 30%, so we'll use that 30% for our calculations. Then we have the consolidate December 31st, 2000 X7. That's going to be the year that we're going to do the consolidation as of December 31st, 2000 X7, as declared but not yet paid dividends of 13,250. So they have dividends that they declared, they haven't yet paid them. Therefore, this is just going to result in a receivable and payable between the two related to the dividends that we'll have to account for in reverse. And then we have the straight line depreciation and amortization is going to be used for the premiums and the discounts. December 31st, 2000 X7, goodwill impairment loss of 25,000. So this is the impairment loss happening in the current year. So we have an impairment loss, meaning first we're going to calculate what goodwill is that we would normally put on the books. Then we have to test it to see if it has gone down or has been impaired. It has been impaired, and it is going to go down by the 25,000. So we'll first calculate goodwill, then think about the impairment. First, we're going to be calculating the goodwill and the differential. So we got our little revealing box here. We're going to pull the information we had from up top, which is going to be the P purchase, the percentage of S voting common stock on January 1st, 2000 X5. So this is at the point in time that the actual purchase took place, not the point in time we're doing the consolidation, that being X7. We're going back to basically X5 to calculate the goodwill here and the differential. So we have the percentage of the stock and then the cost and then the non-controlling interest and the net assets. We typically start off with the net assets then. This is going to be the net assets at the point in time that the purchase originally took place. Then there was a difference between the fair value and the book value, and it was related to the land. So the land was $30,000 higher fair value. Therefore, we would expect if 100% was purchased and no goodwill was involved, you would have the purchase price of $1,182,000. But we didn't purchase 100%, or P did not. They purchased 90%. So we're going to think, okay, the non-controlling interest, which you could think of you might have thought, well, 10%, or they give it to you in the problem. It's given in the problem. Non-controlling interest, fair value of the non-controlling interest is the $123,200. So that means that we would expect then the controlling interest, the 90%, if there were no goodwill, to be this minus this, or $1,058,800. But there was goodwill, and we know that because we know that we paid, the amount that was paid by P was this amount that was given here, the $1,108,800. Therefore, the goodwill is going to be the difference between those last two numbers here, that being 50,000. So we're going to start off with the goodwill of the 50,000, which then later on was impaired by the 25,000, and will go down by 25 to 25,000. Next thing we're going to consider are the intercompany transfers of the inventory. So we're going to put this into our little worksheet here that we're going to be using in order to make our consolidation entries. So we have the inventory sale from S. This is the information given for us. Inventory sale from S to P. So it's going from S to P. That's subsidiary to parent upstream transactions. Prior year 2000 X6, prior year to the consolidation. We had the sales of the 66,000 and the amount not yet resold, which is going to be the 17,000. And then the current year activity, we have the sales of the 81,000 and the amount not resold in ending inventory then of the 10,000 here. So we're going to say, all right, if we go back up, transactions, these are going to be upstream transactions starting with the prior year transaction. We had the sale of the 66,000, and then they gave us the 30%. So if they give us this 30%, we can kind of back into this, pulling out the trusty calculator here. It went into the wrong screen. I'm pulling it down into the proper screen that we could see it with. We're going to take that 66,000, then times the 0.3, 30%, 19,800, this number. Then we can back into the cost of goods sold if we need to. That minus the sales, 66,000, that's going to give us the 46,200. Then we want to think of that amount, how much was the amount that was resold? And so notice we're looking at the same kind of unit amounts for the sales, those same units, unit valuation of the items that are going to be resold. And then we have the ending inventory, these items being related. Now, what they gave us here was the amount not resold, or the ending inventory. So they gave us basically this amount. So if they give us this amount, we could say, all right, there's that amount, and we're going to multiply it times the gross profit, the 30% again, 17,000 times 0.3 is going to give us that 5,100, and then the cost of goods sold will be the difference between the 5,100 and the 17,000 minus the 5,100. Something funny happened here. So let's do that again. We've got the 17,000 minus the 5,100. That's going to be the 11,900. Once we have that, we can back into the amount that's been resold, which would be like the 66,000 up top minus the 17,000. 17,000. That's going to give us the 49 amount that was resold. And then we're going to have the 46,2 minus the 11,900. That's going to give us the 34,300, and then we can get into the last number being the 49,000 minus the 34,300, giving us that 14,007. Our major thing that we're looking for is for the prior year sales will be these items for the ending inventory items. So that's typically the main component we will need. Then in the current year, we have these in the current year where we said in 2000X7, year of consolidation, current year, 81,000. And then they gave us that 30% again. So we're going to take that 81,000 times 0.3. That's going to be the 24,300. Once we have that, we can back into the cost of goods sold, subtracting that from the 81,000. That giving us the 56,700. Then they gave us the ending inventory again. So if we go on down to basically the ending inventory number, we've got the 10,000 remaining. So there's the 10,000. We could take that 10,000 times the 0.3 once again, getting the 3,000 minus the 10,000, bringing us to that 7,000 cost of goods sold. Then we can, of course, back into the amount that was resold, being the 81,000 minus the 10,000 minus the 10,000, and then cost of goods sold, the 56,700 minus the 7,000, and then we could figure out the gross profit, which would be the 71,000 minus the 49,700, 21,300. If we take that 21,300 divided by the 71,000 just to double check that gross profit percent, we'll get that 0.3 or the 30%. So we'll be using these in our calculation shortly. Now let's go into the gain on constructive retirement of S bonds. We're going to calculate this basically with a table format. And this is really where we want to spend some of our time mulling this over, because this is where kind of like the weird thing happened, where we have this intercompany bonds, but they weren't issued from one to the other. One company purchased the other company's bonds from a third party, which results in this gain on constructive retirement thing, which is going to be probably the most confusing component of the problem, or at least the newer confusing component that we have. So we added our little revealer tab over here. We'll note once again the data. P purchases all of S outstanding bonds from unrelated company January 2000X7. That's going to be the current year, the beginning of the current year of consolidation. 1 million is the face amount, years 10, and then the rate is 12%. And then the purchased at 98%, but they were originally issued at the 101. All right, so let's say, okay, so the original proceeds were going to be the 1,010. How did they get that? This is the original issuance when S issued them not to P, but they just originally issued them like normal, and then P had to buy them and mess everything up. But then we're going to say that times the 1.01, 101%, 1.01. And that's going to be the 1,000,010. So that's going to be the original kind of issuance. Then the premium amortized to January 1st, 2000X7, which is the point in time that P then purchased them. So that's going to be the premium was the 10,000. The number of years is 10. Now notice the number of periods would be 20, but we're just considering it now on a yearly basis. So we're going to use the years here. It'll be easier to do, a little bit shorter of a calculation. Then the amortization per year will be 1,000. And then the years to January 1st, 2000X6 is going to be then the 6 years, because they originally were issued in 2000X1. So X1, 2, 3, 4, 5, 6, 7 is going to be the 6 years. Actually, it includes X1, so 1, 2, 3, 4, 5, 6 is going to be the 6 years. So we've got the 6 years, and then the premium amortized to January 1st, 2000 X7 then is going to be that 1,000 times the 6 years, which would be the 6,000 that would have been amortized up to the point in time that P purchased the bonds from a third party. So then if we take the original amount here, that amount was paid, the net amount of the bonds, or the book amount of the bonds at the point of purchase, minus the premium that has been amortized, now we're down to, at the point of purchase by P from a third party, the bond amount of the 1,004,000. So 1,004,000, we're going to compare that then to the price that was paid for the bonds by P. So P paid for the bonds, and they paid at a discount of 98. Now note, we're not comparing this discount amount to the face amount of the bond, as we will do, because P will do that. When P records it, they're going to have a discount that they're going to record, which will be that difference. But we're comparing it to the amount of the book value of the bonds on S's books right now to figure out that gain on the constructive retirement. So that means we're going to take, all right, the 1,100,000 times the 0.98, 98%, and that's going to give us the 980. So 980, and if we subtract out the 1,100,400 minus the 980,000, we get the 24,000. So that's going to be the gain on the constructive retirement. And again, notice that happened in the beginning of the current year. So this is something, a transaction, P purchased the bonds from a third party in the current year. So we'll see that 24,000 coming up shortly. Our next item is going to be income to the non-controlling interest. So we're basically going to be calculating the income that's going to the non-controlling interest. So that's going to be this account down below. So once we finish our consolidations, we're going to come up to this amount. We want to do it basically with a table here, and then we'll see it again with the journal entries. Some of the transactions we will have here are going to be similar, and we'll see again when we do our table. That's going to be the adjustment to that beginning balance or that first journal entry that we typically do, that we've seen in prior journal entries. So some of this will look familiar. We're going to kind of see it in two places as we do that table as well. So let's go forward here. So we're going to say then S 2000 X7 net income. So this is going to be the books for S, or P and S. Trial balance for P and S as of the year we're consolidating, that being 2000 X7 in this case. Then we're going to take the net income, which is going to be the revenue minus the expenses for S. That's going to be the 153,000. That's income. That's going to be our starting point, the 153,000. Now, if there weren't any adjustments to it, we would just break out the 153,000 to the controlling 90% and non-controlling interest 10%. However, we're going to have some adjustments during the consolidation process that we're going to have to take into consideration that will affect the income statement amount. So, in other words, these are amounts that are not included by S in the 153,000, but will be included once we do the consolidation. So then we have the 2000 X6 intercompany profit realized. This has to do with that inventory. So the inventory calculations we did a little bit earlier. We're going to be picking up that 5,100. That 5,100 is going to be included here. We're going to have to make an adjustment for that. Then we have and I'm going to do this one first. So the unrealized intercompany profit. In other words, this was the prior year that we basically reversed. And then we've got basically the current year, which is going to be the 3,000 gross profit. And so that's going to be the current year. So this is the prior year related to inventory. This is going to be the current year related to the inventory. Now, we're also going to take into consideration this 24,000. That's the constructive gain on the retirement of bonds, which we calculated up top. So we just calculated that here. That's going to be included in our adjustment. And then we have the portion of the constructive gain on bond retirement recognized currently. That's going to be the 6,000. That's going to be the 24,000. So we've got this 24,000 here. And then we're going to be taking the years, the 10 years minus the years to January 1st, 2000 X6, or the 6 years. And that's going to give us then, of course, the 10 minus the 6 is the 4. And we're going to take this 24,000 divided by the 4. That doesn't work. 24,000 divided by 4. And that's going to be our 6,000. Now, we'll deal with this a little bit more as we go to the journal entries, because this business with the 24,000 constructive gain is one of the more confusing components, or one of the newer kind of components here. And so we'll calculate it here. We'll also take a look at it, of course, when we do the consolidation journal entries. So then we got the impairment of the goodwill that we're also going to be taking into consideration. The goodwill, you'll recall, went on the books at the 50,000, but then it was impaired in the current period. When the goodwill is impaired, that means it's going to go on the books. You can imagine it going on the books for 50,000. Then it got impaired by 25,000. What's that do? That means we got to decrease it by 25,000. The asset, the other side's got to go somewhere. Where's it going to go? To an expense account for the goodwill impairment, which is going to affect the income statement and affect this calculation as well. So that's going to give us the S income to be apportioned. So the 153,000 plus the 5,001 plus the 24,000 minus the 3,000 minus the 6,000 minus the 25,000 is the 148,100. Then we're going to consider the portion that is the non-controlling interest, that being the 10%, 90% controlling, 10% non-controlling, the 148,100 times the 10% giving the 14,810. So that 14,810 is what we once again expect this number to be, and what it will be after we complete the problem and enter our entries, our closing or elimination or consolidation entries. Next, we want to think about the interest income on S bonds held by P. So we're going to be calculating the interest income. This will help us to consider the elimination entries as well as just basically understand the interest calculations that are going to be taking place. So we're going to say, all right, interest income, S bonds held by P. So once again, we have P purchased all of S outstanding bonds from unrelated company on January 2000 X7. So S issued them to someone other than P, but then P bought them all from other people. And so now they have them, but they purchased all of them. So now we want to consider the interest income. So that means, all of the interest then is going to be going to intercompany. So we don't have that problem as we had in the prior presentation where they only purchased like a portion of them. So in that case, in that sense, this will be a little bit easier, although this happened in the current year, so it's a little bit different. So okay, we have the face amount of the 1 million. The rate is going to be that 12%, the 12%. The cash payment then is going to be the 120,000, which is the 1,000 times the 12%, of course. Now, then we have the amortization of the discount. So to think about the amortization of the discount, let's first go down to our another calculation down here, and we'll calculate that 5,000. So here we're looking at the premium amortization per year for S bonds held by P. S bonds held by P, the premium amortization. So we have the face amount is that 1 million again. Then we've got the purchase, and the purchase here, we're talking about the purchase at the 98, because we're talking about the purchase by P. P's purchasing them at a discount. So the 1 million times the 98 or 98% would then give us the purchase price of the 980,000. Then we're going to say that 980,000 minus the 1 million means that we basically have a discount on P's side of things of the 20,000. There's going to be 4 periods remaining. Why? Because they were originally issued in 2000 X1. So 1, 2, 3, 4, 5, 6, and then January. So then you got four periods remaining. So you're going to be then taking, and we're going to say years remaining. They're 2 periods, but we're looking at years at this point. So divided by the years remaining of 4, and that's going to give us our 5,000 amortization per year. So on P's books, if you just consider this thing from P's books, they see it as, look, we bought, if you eliminate the intercompany kind of thing, they're going to say, hey, look, we bought bonds for 1 million. We bought them at basically a discount of that. We paid 98% on them for that. Therefore, we got a discount of the 20,000. We have to then allocate that discount over the periods remaining. 10 years was the original amount of the bond, only 4 years remaining. So we're going to divide that by 4. That's where you're going to get the 5,000 amortization of that 20,000 discount amount. Now let's just scroll up to the trial balance real quick and just see on P's side of things. If you were to take a look at P's side of things, notice that P's going to be here. The trial balance, they have the investment in S's bonds. It's currently on the books as of 2000 X7 as the 985,000. The 985,000 And then again, it needs to be going up. That's going to go up to the 1 million because they bought it at a discount. So that's going to increase by this amortization amount to the 1 million, which should be the face amount at the maturity of the bond. And then they're going to be receiving payment on it at the maturity value of the 1 million. So that means the interest income calculation, we'll see this in journal entry format that we're going to have in the journal entry will basically be the cash payment, that 120, and then we got to have that amortization of the discount of the 5,000, and we're going to have the interest income that's going to be recorded on their books, not considering the intercompany transfer. This is going to be part of the calculation we'll need to reverse, will be that 125,000. Now we'll use this information to think about what would have been recorded by the parent and subsidiary related to the bonds on their books, so that we can then think about how we could reverse the intercompany portions of them. So if we scroll on down, we're going to say, all right, let's take a look at the information again. There was two types of issues with the bonds. Let's first think of the bonds that are issued directly from one to the other, and then we'll get into the kind of like the more complex item down below. So first we had the April 1st, 2000 X6 P issued bonds to S. So the parent issued the bonds to S directly. So this is going to be the more simple type of transaction where the transactions on both P's books and S books will be similar and will be able to kind of like mirror each other there. So, and there's also no premium or discount. However, we do have this kind of added complexity where there's going to be this accrual that takes place, normal kind of accrual type of issue, which will result in a receivable and a payable that we'll have to reverse because there'll be intercompany receivables and payables. So that means that we're going to have to reverse the accrual that took place last period. And that would have been, okay, well, how much would the accrual have been? Well, we had the 200,000 times the 0.1 would be the 20,000. I'm going to divide that by the number of months divided by 12. That would be this much per month. We have 3 months of accrual that would have happened last year that the payment had not yet happened. In other words, October, November, December of last year wouldn't have gotten paid until the current year. So I'm going to say multiply that times 3, and that would be our 5,000. So that means that our first starting point for P's side of things, P's going to be the one that issued the bonds. So they're going to owe the cash in the current time period. So we would have had an accrual on the books last time period of a payable that we're now going to reduce, and that'll be part of the current payment that we'll have in the current period. So I'm going to say reverse. We're going to reverse the payable that was there last year, and then we're going to have the cash payment that'll be part of the cash payment in the current period. Then we're going to say, all right, what happened currently? The current interest payment would be the 200,000 times, and I'm going to say the 0.1. Now I'm going to record the 20,000. That would be the amount that would be going to interest expense for the entire year. So notice I'm not breaking this out basically how the payments would have for each journal entry for half the year, and then half the year we're basically thinking about what would happen in a journal entry format for the entire year. We would reverse the accrual, which would be part of the cash payment. Then we'd make the first payment, and then we'd have the the accrual that would take place again. So we're going to say for the year, then for the entire year, we would have had interest expense of 20,000 that would have to be recorded for that component. And then we're going to say that the interest payable, this current year's 20,000, the interest of the current year, we're going to have an accrual, same calculation of that 5,000, which is going to leave us with a payable at the end of the year of the 5,000. So then the cash is going to be the 15,000 related to this entry. So total cash that went out is the 20,000. We just simply broke it out between reversing the accrual and then recording the entire expense and then putting the accrual on for the current time period. Now you can see this if we go up to the trial balance up top. We'll see that we have the intercompany receivables. It's going to be included basically in the receivables item here for the receivables and the intercompany payables related to the interest for it. We got the investment in the bonds, in P's bonds on S's books. There's the 200,000, and on P's books we've got the 200,000 bonds. Nothing related to the premium or discount because it was issued at par. So then we're going to think about the more complex item, and then we'll think about the two sides on the other side of things, on S's side of things. So the more complex one is this one where P purchased all of S outstanding bonds from unrelated company. So we're now thinking about P's side of things, which now they were the purchaser of the bonds. So they're kind of like on the other side of the table at this point in time. And we don't have the same kind of symmetry we will have when we think of P's and S's books, because P bought the bonds from a third party, didn't get them issued directly from S. So we're going to say, all right, then if we scroll on down to this item, we're going to say that the amount that they would receive, what we would expect to see on P's books, the one that's going to be receiving the interest on the bonds, we're going to say 1 million times the 12% is going to be 120,000. We would expect to see cash for the 120,000. Then we've got the investment in S bonds. Let's scroll up to our data up top. So here's our trial balance. Investment in S bonds right there. We know that that needs to go up to basically 1 million at the end of the time period, because they bought it at a discount. And we did this calculation to find that. That's going to be this 5,000 right here, right? So that's going to be the 5,000. And so I just lost my calculator. So we're going to scroll back down. There's the 5,000. And that means the interest income we would expect to be recorded at the 125. That's the same 125 that we calculated up here with this calculation, that 125. Okay, let's consider the other side of things. Let's consider then S's side of things. Let's first think about the more simplified transaction that will mirror each other. And we have P issued the bonds to S, so now S is the recipient. So we're going to see this first transaction on P, where the cash is going out to reverse the prior accrual, and the other side going to the payable. Now we would expect the cash to be going in with a debit, and we would be reversing the intercompany receivable. So that's the prior year reversal of the accrual that happened from the prior year. Then we would expect to see basically a mirroring of this transaction, where we had the cash on P's books. We'd have the cash going down, the interest payment of the 5,000, and then the expense of the 20,000. On this side, similar calculations that we would have the interest income instead of interest expense of the 20,000. And then we have the interest receivable, the accrual at the end of the year of the 5,000. And then the cash would be the 20,000. So same kind of concept that we have here. This is the interest income for the entire time period. Cash was paid for the time period of 15 plus the 5 for the 20,000, but we broke it out between the reversal of, in essence, the prior year accrual and then the transaction, basically grouping everything together for 1 year's worth of transactions in like a journal entry format. Okay, so then let's think about the last item related to the kind of more complex bonds down here, and this one will not mirror exactly like we would like, right? The cash is still going to be the same and opposite, right? Cash went up here with a debit. It's going to be going down with a credit here. But then you'll recall that it was originally issued at a premium. So when you're looking at S's side of things, before they think about any intercompany type of transaction, before we eliminate them, we got to think, well, would they just normally have recorded? They would have had to say, well, here's the 1 million, and they issued it at time 1.01, 101%. That means that minus the 1 million is the 10,000, and then they had to amortize that over 10 years. So that's the 1,000. So we would have to amortize the premium, the 1,000, and therefore the interest income would be the 119,000. So when we do the elimination entries, we can go back to here. It's useful to think about these transactions, especially when there's that third-party thing going on, so that we can consider what is happening from a journal entry standpoint, and then that'll help us with our reversal process. In practice, we can actually go through the interest income and the interest expense accounts and see where they came from, and hopefully be able to figure it out that way. In a book problem, of course, then we want to basically reconstruct the journal entry, and that can be useful for us to think about then the elimination entry. Once again, the issue here is the cash is the same, but the amortization of the premium will not mirror what happened on the other side, and the interest expense will not mirror, as we can see from this transaction on P's side of things, right? It's not exactly mirroring, and we'll see how that will impact then the consolidation entries later. So that's going to be it for the first half here. And then next time we'll go into the actual consolidation journal entries in the second component.